So inside the trust, let's say there's $500 million and they earmark $100 million that they want to put into highly tax inefficient investments. So they want to invest this into the hedge funds and the things we talked about, private credit, real estate. As the cash becomes available, they'll begin to fund policies on all of these family members. So they'll spreadsheet the transaction. They'll look and they'll say, okay, here's a 22-year-old female in good health. Here's a 55-year-old male in standard health. And they'll allocate, some of this $100 million among all of those lives. And then that becomes generational wealth transfer. And then what they're doing is they're eliminating taxation on this $100 million indefinitely. But along the way, you've taken something that might grow from $1 to $3 to something that grew $1 to $9 over the lifetime of this family.
Welcome to Planning Reimagined, a podcast from the planning experts at Robin Glenn and RX Investment Partners for wealthy families and successful business owners. Hi, I'm Celeste Moya. Welcome back to another episode of Planning Reimagined. So today's episode is part of a series in which we're focused on family offices, which, as we've mentioned before, are that financial nerve center of affluent families. But today we're going to take our focus on a very underestimated but very powerful and valuable tool when it comes to estate planning, which is life insurance. So we're very excited to talk about this, as this is one of our core abilities, one of the core things that we do within Robin Glenn. And we're also thrilled that we're joined today by Jay Judas, who's a CEO of Life Insurance Strategies Group, and he's an expert in the field both domestically and international when it comes to insurance. And Jay's specialty is in crafting those very unique custom solutions for our high net worth families that we work with. So Jay, thank you so much for joining us. We really appreciate it.
Celeste, thanks so much for having me. It's great seeing what Robin Glenn's been doing in the marketplace.
Thank you, Jay. We really appreciate it. And I feel like this is more of a family reunion, right, than just another podcast because we've known each other for so long. It's always been great to work with you. We also have with us our very own Chris Stiegel, who's our in-house life insurance expert. He also is just a maestro at navigating the needs of high net worth clients when it comes to crafting insurance solutions with a lot of creativity.
Yeah. Hi. Thanks. Yeah. I'm in Chicago traveling with Starry as I do. So pleasure to be here. Thanks.
Thanks for joining us, Chris, even though you're in the middle of travel and meetings. We really appreciate it. As we do. It's part of what we do, right? So
It sure is. It sure is.
So as I mentioned, Jay, at the start of this, life insurance, as you know, is one of our areas of expertise at Robin Glenn. We utilize it, I would say, almost on a daily basis to talk about estate planning, to facilitate the transfer of wealth to future generations, because it can cover things like estate taxes, equalize inheritances. It can buy out a non-active family member in a family business. There's so many different ways that we use it very strategically. But today we're talking about life insurance as a tool for family offices, something they can use from a planning perspective. And life insurance, sometimes it's not seen as an asset. So let's start with just the high level at the very beginning. Can life insurance, Jay, be considered a cornerstone asset, just like any other investment in a portfolio?
Well, as you know very well, Celeste, this is one of my kind of passion areas in life insurance, is showing people how life insurance can be positioned as an asset class in a portfolio. And I'm glad I'm reunited with Chris today because he and I have had discussions about this, I bet, for at least 10 years. And so I guess, and starting it broadly, one of the challenges in positioning life insurance as an asset class is that life insurance people and investment people tend to speak two different languages. And when they try and put those languages together, it doesn't make sense to anyone. As an example, a lot of times investment people will look at life insurance and they'll say, oh, well, let's look at the death benefit of the policy or the cash value, money that's in the policy, and we'll do a rate of return. So we put in X and it's worth, X plus whatever today, that's a rate of return of 4%, 5%. But that really doesn't do justice when evaluating life insurance as an asset class. So we can start there. And, with your permission, Celeste, I'd love to dig in a little bit more
of course.
how that works.
Absolutely.
when on the investment side, when investment people, particularly in family offices, are evaluating investments, they've looked at things like modern portfolio theory. They calculate a Sharpe ratio on investments, which looks at the volatility of the investment. What is the chance that this investment's going to hit a certain rate of return and stay in the area of that return? Well, imagine if that can be done for life insurance. If someone can take a life insurance policy and study, look at it from the attributes of an investment and say, okay, life insurance, what kind of rate of return can we expect from you? What kind of volatility can we expect from a policy? And knowing that, we can then position it in a portfolio. So I'll give you an example. So if we kind of look at whole life, and it can be just about any company's whole life policy, life insurance, particularly a whole life product, has a pretty decent tax-free return, right? You're not paying tax on the growth inside of life insurance, and you don't pay tax on the death benefit. So this kind of rate of return might be in the neighborhood of 5, 6, 7% without tax. Now that's a pretty good rate of return. So then let's look at volatility. So life insurance is very stable compared to almost any other asset class. If you look, were to do math and look at the Sharpe ratio on life insurance, you'd see that it has a very high probability of very little volatility. So then that allows you to really position it in a portfolio. So at one end, you might have alternatives, things of great risk, hedge funds, that type. At the other end, you'd have municipals, bonds, things that aren't very, I guess maybe the word is sexy, right? They don't really have high rates of return, but they're very stable. Well, you can put life insurance in above that. You can say, look, I'm getting that stability, even more stability from life insurance than I am from bonds and municipals and those kind of, I guess, lower end investments. And that helps with the positioning in the portfolio of life insurance and allows you to move up the risk ladder to other riskier investments. So, I mean, you could get me going for a long time here. I mean, Chris is probably smiling because we do this all the time, but it's been great to see kind of family offices embrace this kind of picture of life insurance in the portfolio and to really treat it as an investment, not just as something used for protection.
Absolutely. I mean, that's such a good point as an investment, as a diversification tool. I think that's something that we sometimes struggle with clients to comprehend is that insurance really is an asset. It's an important asset. It's an asset like any other that should be managed and reviewed, that changes, that's dynamic over time. So thank you for sharing that, because all of that, I think, really ties into a lot of what the family office executives, their CFOs, COOs are looking at and doing and trying to manage on the investment side. And looking at life insurance in that space is important for them as well.
And Celeste, I should note too, I used whole life as an example there, but even if you used variable products like variable universal life, private placement, that kind of Sharpe ratio that I discussed, it really doesn't move too much. So along the whole spectrum of life insurance policies, you're going to expect a pretty decent tax-free return. It's a low number, but it's tax-free, so that makes it even better. And then you'll have that kind of stability of that rate. You're not going to see a lot of volatility in it. So again, not just whole life, but any type of life insurance will come out with the pretty same numbers when we're applying the Sharpe ratio.
Yeah, absolutely. So thank you. That's a great way of positioning it and explaining it. So now that we've talked about, life insurance as an asset within a portfolio, Chris, what we do on a day-to-day basis is talk about life insurance for estate planning. I mean, that's the majority of the conversations that we're having. Family offices, if it's the family or if it's the executives that are running the family, this is a topic of conversation that is very much top of mind right now because of all the changes that are happening in the estate planning space. So can you share some insight on how life insurance can act as that financial linchpin in managing multi-generational wealth?
Yeah, no, for sure. And, I think life insurance, while it's never the only answer, it can be, a critical element in the estate planning and how family offices sort of approach, multi-generational planning, trying to keep and maintain, all the wealth that they worked so hard for, in the family for generations to come. I think that, and you hit it on the head, right there. I think one of the biggest uses of life insurance in the context of estate planning and family offices is simply providing liquidity at death of the insured, really to make sure that there's readily available funds to handle things like estate taxes and maybe debts and things like that that the family and the family office has. And the reason that's so powerful is because it helps eliminate the potential that the family has to liquidate assets in order to pay that estate tax. I mean, right now, what is it? The exemption, I think, against estate taxes is around 13 million. It's going to be cut in half, and at the end of 2025. And so, anything above that threshold, we'll say 6 or 7 million for singles, and double that for married couples is going to be taxed at 40%. So if you're sitting on a significant amount of real estate or non-liquid assets, trying to come up with significant sums of money to pay the IRS 9 months after passing can be wildly burdensome for families. So life insurance is sort of almost the best class of asset you can have to combat estate taxes, because again, it's dollar for dollar. It's completely liquid, and if structured properly in trust, it's not subject to estate taxes. So it becomes a wildly important asset to combat things like estate taxes.
And I say this all the time, wealthy does not mean liquid. So when the time comes to pay that estate tax, generally it's probably not the right time. The market's down. The real estate space is not doing as well as it probably should. You have to sell a property for less than what you wanted to, or they have to sell things that they don't want to get rid of to be able to pay the tax, because the IRS is going to come after their money, right? I always love it when clients ask, well, how can I avoid estate taxes? I'm like, well, you can't. So you have to plan for it. You can plan, to make sure you are being efficient about what is considered taxable, but it's you still are going to have to pay, or your heirs, your estate is going to have to pay those taxes at some point in time. And you also touched on liquidity. Another thing I mention to clients all the time, life insurance foundationally, covers two things. It's either liquidity or asset protection, in some cases both.
Right.
And so that's the key thing for clients to remember. Life insurance, especially when it comes to estate taxes or that transfer of wealth, is liquidity at a time where it may not be the most opportune time to just because you have the assets or you can liquidate something doesn't mean that you should. And it's also the most cost-efficient way of doing it. Because when you think of, I could go liquidate a $50 million property, or I have a $50 million policy that did not cost $50 million by any means, that is going to be, for our savvy clients, for all these business owners that we talk to, a much more efficient way of covering that, that tax that's going to be due at that time. So we know life insurance, we believe in it, we love it, right? It's a tool we use all the time when it comes to estate planning. But specifically, Chris, can you talk about some of the strategies that we implement or we help clients implement frequently? These high net worth clients that are trying to preserve legacies, preserve their wealth.
Yeah, for sure. And, just kind of going back just a little bit on some of the other uses of life insurance and how it works in the, again, family office and high net worth clients. Like, there's another idea of, we have the liquidity issue at passing and having to fire sell things, but there's also the potential of conflict of heirs. And so when you're dealing with family businesses, like you just mentioned, sometimes you might have one or two kids that are actually in the family business, and you have other ones that are not in the family business. And sometimes, in addition to be able to facilitate estate taxes or paying estate taxes, that death benefit can also be used to sort of equalize inheritances, which can be really impactful to make sure this, family harmony continues to go year over year. And then again, in the family office context, this idea of a financial safety net is there. So I like to say sometimes the liquidity is king, even when you're a real estate mogul. But if you think about, just having liquidity generally, if you've got that entrepreneurial spirit, which so many of our, clients do, because that's how they built their wealth, sometimes that spirit, is in the generations to come. And so to help, allow and give the possibility for those future heirs to also sort of explore their own entrepreneurial spirit, sometimes having that cash on hand can help the family office sort of, let those opportunities blossom.
So you mean not all siblings get along, or the spouses don't come in and have the same mentality that the family's always had? That's
You know what?
shocking.
It's true. Yeah, some are going to be really interested in the family business, and some are going to really want to explore their music career. Like, who knows? But hopefully they're all getting along.
Yeah,
Yeah.
absolutely. Once again, so also life insurance provides peace and unity within the family at some point. Right? Another important point to talk about. It's something that I'd be remiss if I didn't talk about, that I mentioned to advisors and clients that we meet with all the time, is how important it is to work with advisors that understand that life insurance, to some of our colleagues, it solves all world problems, right? So the solution to every problem is life insurance. Whereas we take a very different approach. We're very much planning focused. A client has to have that estate plan, their financial plan, tax planning, so that we can come in and be efficient and assess the risk, because ultimately life insurance is risk management. So we need to know where to assess that. And so we have an example of a client we're working on right now who just was successful, grew too fast. He actually comes from another country, so he wasn't aware of all the estate tax issues that he was to face, didn't structure his business properly. A lot of that goes back into his estate at his death. And now he's realizing that, his estate has grown very significantly. 150 million is where he is right now. And if something happens, there's a huge tax bill for his children. And for, if something happens to him and his wife, he is married. And so we've actually gone through a process where we have them structure everything properly, get the right estate plan in place, the business planning, all of that first, so that we can then go in and assess once again, what is the risk? And we see that a lot with clients. And I'm sure you can talk about this too, Chris, and Jay too, where we just have clients that haven't done the right planning, but doing that planning is so important so that the life insurance enhances the planning, because that's the ultimate tool, is for it to enhance and fortify the plan versus be the plan.
Yeah, no, totally. Like, I always kind of make the joke that the best time to have done planning was, yesterday, and the second best time is today. But it is, I completely agree with you, and that absolutely is the philosophy of Rob and Glenn. It is to, do everything we possibly can structurally, through different corporate entities, through trusts, products if they make sense. And again, just sort of right size the situation, make sure that the clients that we're working with are in a best in class situation today. Sort of, I call it backfilling, backfill the risk with risk mitigators such as, life insurance and annuities, and things like that. And then, even more importantly, to an extent, to make sure that those entities and those structures are managed and maintained and continue to evolve with the needs of the family. Because what happens, what is going on today is not going to be the same thing that's happening in 10 or 15 years. So being able to work with families that closely and help them, evolve their structures and their estates and their thinking and how they want to plan for their estate is also key in how we manage, all the, like things like life insurance within the family.
So we recently had a couple that was looking to see if they needed more life insurance. And so we set out to work with their attorney. And what we discovered at the end of that was that they could be served from having SLATs. So spousal lifetime access trusts, or a married couple, or they don't even have to be married, but they each have their own individual sort of irrevocable trusts. And there's some planning that goes with this. But at the end of the day, they just need any more life insurance. And so that just goes to kind of the point I think, Celeste, you're making and Chris has made here, that maybe life insurance isn't the answer at the end of it, but you don't know until you do the rest of the planning, which is exactly what happened with this couple.
Absolutely. That's a great way to put it, Jay. Yeah, you need to do the planning to know, does it fit in, and how much of it. We can, obviously, if you want to come to us, and we can sell you a lot of insurance, but that's not the right approach. That's not what we like to do. We prefer to make sure the planning is in place. So just quickly, Chris, if you can touch on, people think of life insurance, and first of all, they don't want to think about it, right? I get it. People cringe when they think of life insurance. We love it because we talk about it every day. We know how important it is. We see it work.
Chris and I think about it all the time.
Yeah.
To talk about it. So that's
yeah, absolutely. Not so much, probably 99% of the world. And so
I'm great at a cocktail party. Yeah. Deflates the room rather quickly.
So funny story. If we're at a party and somebody asks me about life insurance and my husband's there, he's like, don't. He's like, just don't. He's like, she's going to talk forever and we're going to be here all night. So very true. We feel about it a little different than most. So uh, people think about life insurance though, and they think it's just expensive, right? And that is a misconception to a certain level. Yes, there's a cost. Everything has a cost. There's nothing in this world that's not going to cost you something. But how are these strategies being funded so as to not compromise other financial goals that the families have?
Yeah, for sure. Right. You have to balance that. You have to balance that out, right? I mean, at the end of the day, cash flow is cash flow. That's how families are always going to look at it and what they're going to get at the end of the day. I agree with you that life insurance shouldn't be seen as expensive. Of course, it has a premium to it. I think it also has a fantastic return to it. As a put on a death benefit mortality put, if you will. Or via the cash value buildup, which we'll kind of talk about here in a second as well. But I think that to more your point there, your question though, the different ways that the insurance policies are funded. I think that in the context of estate planning and family offices and higher net worth planning, and Jay mentioned this a second ago, it all kind of starts with a trust. Now there's a whole bunch of different types of trust out there, but at the end of the day, the best way to hold a life insurance policy, generally speaking, is going to be in some sort of an irrevocable trust. And the reason you do that is because once it's inside of that trust, it is no longer subject to estate taxes, which is key. You don't want that death benefit to be taxed. That's not its purpose. The purpose is to pay the tax. And so if you can maximize that by not having a tax, then you win. So you're always going to use an irrevocable trust. To fund the trust, the most common way, I think, is for families to make gifts to the trust. So I mentioned a few minutes ago that the exemption, the gift exemption, the estate tax exemption is it's a little over 13 million right now, which means that a family could gift $13 million into a trust. If you're married, it could be 26 million into a trust, and then those dollars could be utilized to acquire a life insurance policy. I think it's the most common way that it happens. But some families are going to be interested in trying to find and maximize their cash flow in other ways. So maybe they're pushing most of the money back into the business, or maybe they have other kinds of private equity and venture capital, whatever it is that they like to invest in, and they want to deploy those dollars there because they're getting 15-20% returns on those, and they don't see life insurance as providing that same level of return. Which is true, but again, that's not what it's there for. So some families, if it makes sense, again, if they're getting that kind of a return in other places, might look at something like premium financing to acquire the life insurance policy. While I could probably have a whole session just on premium financing, so I'll keep it brief. But the idea is relatively simple. You're just going to borrow dollars from a bank or some sort of a lender, and then you're going to utilize those dollars to make the premium payments. And so again, depending on how leverage fits in with somebody and how the returns are elsewhere and how the life insurance policy is structured and whatnot, premium financing could be a solution for some of those families that are trying to maximize their cash flow in other areas, but also want and desire that life insurance death benefit.
So in summary, there's flexibility, right? It's not a one size fits all. There's going to be different options that we look at depending on where they are from a funding solution. What do they have access to? And so when we go back and ask clients a lot of different financial information, sometimes they're kind of weary, but you're just my life insurance person. The reason is because we want to make sure that we structure it in the most efficient way for them financially, from a tax perspective, lots of different reasons why we look at the financial information as well. So thank you for sharing that. That's an important component. Obviously, the cost is an important component of life insurance, and we need to understand how it's funded. So we've talked about the traditional ways that we use life insurance, or some of those traditional products, right? We talked about some survivorship options, and there's just so many different products that we look at and ways that we structure them for our affluent clients, for family offices, to ensure that they're meeting whatever that goal is. Many times it is estate planning, but there are different reasons why we would use different types of life insurance products. At the very beginning, Jay, you mentioned variable as an example. Variable universal life is a product that we look at when it makes sense for clients. Now, kind of shifting gears a little bit, there's a different type of variable universal life product that is functions different than, I would say, traditional life insurance. At the foundation, it's still a life insurance product. It's still a variable universal life product, but it does have a specific appeal to those folks that I would say are in the ultra wealthy category. And this is private placement life insurance, commonly referred to as PPLI. Now, out there on the internet, as there is probably with anything you want to find, there's a lot of information. Some of it is good, some of it is bad. I think it'll cater to whatever you want to hear. If you type in, why is private placement bad? Then you'll find that information. Why is it good? You'll find that, right? I also hear a lot of chatter about it in the financial professional community. I frequently get the question of, do you guys do private placement? What is it, or can you explain it? And then also clients will come and say, well, my friend at the country club bought a private placement policy, so this is absolutely what I need to buy. And so many times we also have to talk them off the ledge because it is a very specialized product that doesn't fit just everyone. It's not I would say, broad application product. So I know, Jay, this is an area of specialty for you. This is something that you talk about all the time. So can you start by kind of demystifying private placement life insurance and explaining high level, how does it work and what sets it apart from just traditional life insurance policies?
Sure, Celeste. And I'm glad you brought up variable universal life, because that's a great starting point for kind of explaining what PPLI is. And PPLI really functions the same way as variable universal life, except that people can bring their own investments to the policy. So as an example, in variable universal life, a policyholder usually chooses from a selection of underlying investments from a carrier's platform. And they'll have brand name insurance dedicated funds under there, like Fidelity or Vanguard. In private placement, however, this is for qualified purchasers and accredited investors. So these are people that must qualify to buy PPLI first. But with PPLI, instead of having an insurance company lay out a platform, those kind of regular funds, the policyholder can bring their own investment manager to the policy and have that manager select investments that underlie the policy and make up the policy's cash value. So one of the other differences is with VUL, you might have some guarantees in the product. There might be, I call them guardrails, right, where you can't lose all your money. At the same time, you may even have some limits on how much you can make. Well, PPLI is much riskier. You don't have those guardrails. So the policyholder can benefit from all the investment growth that they can. Their investment manager can bring them from the investments underlying the policy. Or if those have huge losses, those are reflected in the cash value. You could absolutely go the other way. So it really, again, is for people that are used to taking some risk with their investments, but also having a professional money manager, which you don't really have in variable universal life, which I call more for the retail space. So that's a good starting point for explaining PPLI slots.
Yeah, so much more custom, right? They have the ability to customize investments. I think a lot of investment managers or wealth managers, that's why they like the concept of private placement, because they're still able to manage those assets for their client. It's not something that has to be taken out of their portfolio and managed by somebody else. But you mentioned there are qualifications for it, right? And so this is why when we're talking to clients and they say, my friend, on the golf course said I needed private placement, we have to ensure, is it a right fit for the client? Many times I also mention to clients, this may not be your estate planning tool. We need to talk about doing other planning, your other life insurance, your traditional life insurance planning, potentially first, and have that taken care of before we're looking at this product. And I think that's a good segue into, then why would a high net worth or ultra high net worth individual or family, why would they want this product? How does it cater to their unique needs, Jay?
Well, the number one reason that people are interested in PPLI is it builds tax efficiency where you have highly tax inefficient investments. So I'll stop there for a second, and I have to point out that this is a life insurance solution. So there is life insurance in this transaction. And people do need to have some type of life insurance need when considering PPLI. And so a normal PPLI would find a policyholder wanting to make investments in some investments that have a lot of taxation held in a taxable account. So alternatives, hedge funds, real estate, things that draw a lot of maybe ordinary income. And so, how do you tackle this? Well, obviously you can make those taxable investments. And, if you live in places like Illinois, New York, California, you could be looking at, getting, 48 cents on the dollar at the end of the day. But if you make those investments under an insurance structure, then you eliminate taxation while they're held in the structure. And although you can access private placement policies for distributions, in my experience in over 20 years, I think I've seen probably less than 10 policies ever touched for distributions. The people that are buying them are such wealth that they typically die, and those investments get turned into the death benefit.
Wow.
So it does become as much of a tax efficiency play as it does an estate planning technique.
Yeah, no, that's an important point. It is life insurance. There's a life insurance component. You're right. There has to be a life insurance need. Once again, when it goes back to clients come to us and say, I need private placement, that's another part of the question. I mean, do you really need the insurance component of it? Because yes, there's a lot of flexibility and tax efficiency. Can you give examples of some of those tax inefficient assets that you see rolled into these policies?
Yeah, I mean, right now, private credit is a big hotspot in the investment world, and we see a lot of people investing in private credit under these policies, and the same is true for real estate. These aren't investments where you're going to make them and then in a year say, okay, thanks, private placement, I'm done. Private placement, as I said, is insurance. And so what that means is in the early years, to have this qualify as life insurance, you'll need to buy a significant amount of death benefit. And then once you've met the government's test that this is a policy, you get to lop a lot of that out. So what that means is private placement isn't something that you buy and say, okay, I want to hold this private credit for a couple of years, or this real estate investment, or life settlements, multi-strategy, whatever the asset class is, and then you exit it in a few weeks. This is something that you need to hold for probably 15 years or more to really see the benefits. So it's not a quick rich scheme in any way. It really is a long-term planning technique. You can, as I said, you can expect a lot of people will hold this until they die, as opposed to taking distributions out of it.
Yeah, great point. It's definitely something you hold. And I think that holds true a lot for life insurance. If it's something that they intend to take cash out of in the future, potentially, as you said, it doesn't always happen. But if they do, they need to realize it's a very conservative tool for that. And it takes time for that to actually grow. So do you have, in working, I know that you work with family offices and advisors that work with family offices. What are some examples, if you can share some, of some family office situations you've worked with recently or in the past few years where private placement catered to a unique need or something that they were looking for?
Yeah, and so we're actually seeing, Celeste, private placement grow quite a bit in the family office space. And I use a good example in sort of the corporate world. Companies will buy life insurance and they might use it to fund executives' compensation plans. So they might, give a list of all the executives to the insurance company with their ages and gender and health, and then their budget of money they want to spend on the policies. And they can buy policies on all these executives and then use the policies to take distributions to pay benefits or to use the death benefit. Well, family offices are beginning to approach private placement in the same way. Now, I'll give you an example there. So let's say we had a family that had 15 members in it between ages of like 22 and 60. And the trusts that the family office is responsible for, so inside the trust, let's say there's $500 million, and they earmark $100 million that they want to put into highly tax inefficient investments. So they want to invest this into the hedge funds and the things we talked about, private credit, real estate. And so, as the cash becomes available, they'll begin to fund policies on all of these family members. So they'll spreadsheet the transaction. They'll look and they'll say, okay, here's a 22-year-old female in good health. Here's a 55-year-old male in standard health. And they'll allocate, some of this $100 million among all of those lives. And then that becomes generational wealth transfer. So what happens is, they'll know based on mortality tables, we can expect these family members, certain family members to pass away at this age or this date. And then what they're doing is they're eliminating taxation on this $100 million indefinitely. So as these family members pass away, that income tax-free death benefit is coming into the trust that can then be used to support future family members, right? So there will be tax later when those monies are distributed from the trust to support family members. But along the way, you've taken something that might grow from $1 to $3, to something that grew $1 to $9 over the lifetime of those family members.
Absolutely. We've also seen, clients that are in unique situations, athletes, that earn income in lots of different states that have tax issues that maybe a traditional executive doesn't, utilize private placement as well for tax efficiency. Are there any scenarios that you've seen in that space?
So let me switch kind of gears to private placement annuities. And so kind of, my experience with professional athletes buying life insurance is they're sold on the savings attributes and the tax kind of efficient way you can pull money out. But what ends up happening is a lot of those athletes, they get into their early 30s and they pull too much money out of the life insurance policy and they get themselves in a spot where if that policy lapses, they have to pay all this tax on things that they pulled out. So it becomes almost too punishing. A private placement annuity works similarly to a regular annuity, but it lets the professional athlete use their money manager to kind of select the investments that are under the annuity, and then the annuity, there's no death benefit, but you pay tax on the money before it goes in the annuity, and you can't touch the annuity until you're 59 and a half without a 10% penalty. So now the athletes, if they need the money, okay, they can get it. They have to realize there's a penalty, but they don't face the harsh consequences that come with life insurance if they do have to tap it. And so more and more, we're not just seeing professional athletes put their, a part of their salary into private placement annuities. We're also seeing for their endorsement deals. So their endorsement companies are saying, okay, you just got this deal with Nike. They're giving you, $5 million a year. We'll do some, short-term planning with some of this money. Obviously paying taxes. Let your mom. You got to buy your mom a house. They've always got to buy their mom a house, and then we'll put like $1 million into this annuity every year, private placement annuity, and that'll grow. And when you're older, you'll be very thankful that you did this. And so, that's been professional athletes, endorsement companies has been a really kind of growing market for private placement annuities.
Yeah, it makes perfect sense for them to utilize that versus other strategies. I think something you said is super important to kind of expand on. It has to be managed properly. You have to have the right advisors, people that know what they're doing, not just with implementing the policy, but that ongoing management. These are absolutely not, actually, I should say, set and forget it type of policies, because it is a living, breathing asset that changes, that's dynamic, that maybe, yes, you have to leave the assets in there a certain amount of time. It's not going to be immediate returns. But even during that time frame, there's a lot of management that comes with these policies. So that's super important. We've seen some horror stories out there on the internet where people are essentially talking bad about private placement, but usually it's because it was sold to the wrong person who it shouldn't have been sold to. They weren't qualified probably to have this type of product. It wasn't managed properly, and probably expectations were not set properly as well. They probably told them, you're just, this is a have your cake and eat it too type of situation. You're going to get rich, no problem. And so I think a lot of the issues that we see around private placement are just that expectations, bad management, and just the wrong person buying it, which can be applicable to lots of different, life insurance situations. So when we talk about private placement, generally we always hear the term investor control, which could be something out of a mobster movie. I don't know. It sounds very serious, right? So Jay, can you explain to us, what is investor control and why is it so important for somebody who is looking at a private placement policy to be aware of it?
The IRS views life insurance products as long-term planning structures, and as a result, they give them tax benefits. So if you look at how the IRS looks at taxable accounts, they have capital gains, ordinary taxation. Within life insurance, they say, okay, people are holding on to this for a long period of time, and they're really not actively involved in managing it, right? In most life insurance company is choosing, their manager, they're managing it itself, they're picking the custodian, and in exchange for that, they get these tax benefits, the inside tax-free buildup, tax-free death benefit, the ability to take out money tax preferred. So when we switch to private placement, those characteristics do have to carry over. So we've talked about how, yes, you can have your investment manager then choose the investments, but that's where it has to end. So the policyholder, the insured, related parties can't have a say of what is invested under the policy, and they can't actively manage that going on. Because if they do, the government says, wait, well, now you've done something, you violated investor control doctrine, meaning you've taken control of these investments that are under the life insurance policy. So we should tax you on the growth of those investments every year because you're controlling them. And so by having prohibition against being able to control the investments, to say, okay, policyholder, you can talk to your manager quarterly about your investment philosophy, your tolerances, your goals, but you can't tell the manager, hey, pick that private credit fund, or pick that real estate investment. That's not how this works. So for some policyholders, that's going to be tough. For people that are control freaks, maybe private placement isn't for them. But in switching, and thinking about the family offices, these are people that are pretty removed from the investment decisions that are made on their behalf. So it's a relatively easy fit in the family office world. You have professionals managing your money, and you as the policyholder or related party insured, you don't have hands-on at all. So I'm glad we did get to talk about investor control, Celeste, because that's where the IRS will look at these transactions and try to find whether it's auditing the emails between the policy owner and the investment manager to see, okay, has anything nefarious gone on here? That's how a private placement deal could fall apart. So again, people need to be careful and don't take control over the investment decisions in your policy.
Yeah. Chris, you look like you have a thought.
No, always thoughts. No, just a question, because you brought up family offices, and sometimes they're heavily involved in the investment decisions, and sometimes they're a step removed. But some of the family offices are, they're pretty well plugged into the investments that the CFOs are, going out and investing in or buying up. How do you help, build those guardrails? How do you help build that wall that says, look, you can't have a big say in what this policy is going to actually be invested in? Can you just kind of talk about the guardrails that how whenever you are engaging a family office, how you talk about that?
Yeah, this is important, because if you have family members involved in the governance there, that kind of family office, you could have an investor control problem. So structurally, how I like to see family offices set up that are going to private placement is I like to see the family having a separate LLC set up, where their investment professionals, their employees, are the GP owners of that LLC, and then the family can be LP owners that provide funding. And so that really, now you've got individuals who are running the investment entity, the family office, that are not family members and have kind of control over what that investment entity does. And obviously, if the family doesn't like that anymore, they don't have to fund it. They can pull their funding. That's how you get out of that arrangement. That's how we kind of like to set up or see that guardrail set up, that separation that gets us away from investor control.
Makes sense. And then, I love the discussion about, the longevity of these contracts. And it's, Celeste, you hinted at this, it's never a set it and forget it kind of contract. It has to be, right? It has to be continually managed. And I'm guessing, Jay, that whenever you're working with the family offices, you're trying to educate multiple generations, because they might see that asset class and 15, 20 years into it, think they can do something with it that maybe they actually can't. So it's not just managing the policy to make sure it adheres to just regular life insurance rules, but it's a constant education on multiple generations to make sure they continue to understand how that asset class works.
Well, yeah, and sort of, I don't mean this to be a commercial, but this is sort of one of the attributes of Robin Glenn, is that when we look at counterparties, when we look at producers to work with our individual clients, is we have to have succession planning involved, because it is this long-term education. And in the PPLI world, there's probably, when you think of life insurance, there's thousands of life insurance agents and things out there. But in the private placement world, there's probably 20 or less licensed firms like Robin Glenn that do any volume and have experience in private placement. But then a lot of those might be 1 or 2 person shops. And so if you're a family office and you use that example I just did, you just bought 15 policies on people, and the youngest is 22. Well, an affluent 22-year-old female today could easily live the next 80 years. Well, who's managing the policy? Not the 70-year-old life insurance producer that maybe sold it to you. No, so you want to have an organization like Robin Glenn that has succession that can continue that education. Because I won't be around. I'm not going to be around to do that education. So Robin Glenn, you can do it.
You're so healthy. You take care of yourself. You're going to be on an island sipping some margaritas or something. You're just not going to want to be bothered at the time. Yeah,
that's right.
Absolutely. No, that's all great. Really important information on the private placement. And once again, just to emphasize, it has to be for the right client, the right need, the right strategy, managed by the right people, and with the right expectations of what it does.
You've got it, Celeste. And I kind of, looking back at this interview, I kind of, covered a lot of rules there, and I don't know if I made private placement very attractive, but it really is. If you do it all the right way, you have professional management, kind of the insurance rules do really let that money inside the policy grow much more quickly than in a taxable account. And it makes, it can make all the difference to a family passing generational wealth to have your money protected under a policy rather than in a taxable account.
Yep, very powerful estate planning and legacy protection, legacy preservation, wealth preservation tool for sure. So, in summary, life insurance, it's not just a policy. We can talk about it all day long, and we're actually going to add some documents and white papers that our viewers and audience can access and learn a little bit more about this, because there's just so much more that we can expand on that we don't want to, we could be here for 17 hours. You can have a Joe Rogan show type, on life insurance, but we won't do that to people. It's a very versatile tool. It can be utilized for many different strategies. Obviously, we talk about wealth preservation, estate planning, that preserving that wealth across many generations, which is a struggle, as we know, for a lot of families. So we want folks to know it's an important tool, at least to consider, and to find experts that understand how it fits into that high net worth estate planning, wealth preservation space. Jay, thank you so much for sharing your expertise. You as well, Chris. But Jay, if you can explain quickly who you normally consult with for our audience, if somebody wants to reach out, and how they can engage with you.
Sure, thanks, Celeste. So Life Insurance Strategies Group, we don't sell products. So we're not licensed insurance people. We work with insurance professionals like Robin Glenn if there is an insurance solution to be implemented. So we're fee-based consultants. We're generally engaged by affluent individuals, families, and companies to help them investigate the acquisition of life insurance in some type of complex situation. Could be estate planning. You might be looking at PPLI. There might be premium financing. Chris mentioned a business might be looking at business succession planning or covering key people. And so we really sit on their side of the fence and are a valuable member of their team in searching for a solution. And that might include even doing a beauty contest for brokers, helping them select a producer. I mean, Robin Glenn should fit 99% of the people. But we certainly, in some situations, want our clients to consider Robin Glenn. And then we help manage and supervise the transaction, so our clients feel like they have as much knowledge as the people on the other side of it. And of course, you can find us at lifeinsurancestrategiesgroup.com. You can email us at hello@lifeinsurancestrategiesgroup.com, and you can find us across all the social platforms.
Thank you so much, Jay. And we'll definitely include your contact information in the show notes. So on that note, hopefully everybody listening or watching has found this information beneficial, has a better understanding of how family offices and just affluent clients in general are using life insurance. And now maybe go back, reassess, how is your estate, how is your assets being protected? Can you take some of these insights and apply them to preserving your assets, protecting your wealth across many generations to come? Thank you so much for joining us today, and we'll see you in the next episode. Thanks for listening. Don't forget to like and subscribe, and please be sure to follow on your favorite podcast player. To connect with us, you can email us at hello@robinglenn.com or schedule some time with us via the link in the show notes. You can also find us on Instagram and TikTok at Hello Robin Glenn.